Good morning from the conference board. My name is Gad Lebanon and I'm chief economist here at the conference board, chief economist North America, I should say, at the conference board. Welcome to our February edition of Economics Watch. This time, as opposed to the last couple of times, there is no government shutdown. Stock prices are rising. And here in New York, the sun is shining and the birds are singing. So in this optimistic mood, we are going to tell you what we are going to see and talk about in this webcast. So the main topic that we are going to cover today, in addition to our regular US and global outlook, is the US housing market. We have a special guest for that we are going to present in a minute. So we're definitely going to focus on that. Construction and the housing market have been weak spots in the US economy in recent years, so we're going to try to understand why and what the future holds in that regard. Before we dive into the webcast, I just want to remind you that you are welcome to ask questions during the webcast. You don't have to wait until the end, and we'll just type them and we will take them as they come. There is also CPE credits for those who are interested. You need to type your full name and email address in the space provided. Click OK on the 3 pop-ups that occur during the program, and you have to stay online for the entire webcast, and the credit is available only for live participation. So who we have with us today? First, our special guest is Mark Pelham. He's the Deputy Chief Economist and Vice President in Fannie Mae and one of the leading experts on the US housing market. Welcome, Mark.
Thank you for including me today. I really appreciate it.
Thank you for your time. And we have in our Brussels office in Europe, Abdul Arumban, Senior Economist. Good afternoon, Abdul.
Good morning, Gad.
Thank you for being here. And as usual, my partner in crime, Brian Shaky, a senior economist at the conference board. Good morning, Brian.
Thank you, Gad, and looking forward to talking about the links between birds singing and Federal Reserve interest rate policy changes.
Good. Yeah, there's a strong link there. But before we get to the US, Abdul, let's start with the background, the global background, what's happening in the global economy in recently and in the future. But before I let you talk, I want to hear from our audience. So we have a poll question that the studio is putting up. Which unknown will most influence your business planning in 2019? So there are a lot of options here. Federal Reserve monetary policy, Brexit, US-China trade negotiations, Chinese economic performance, Euro area economic performance, emerging market risk, oil prices. Again, there's a lot to read here, so I will give you a little more time to think about that. Again, which unknown will most influence your business planning in 2019? I'm going to close it soon. 5, 4, 3, 2, 1, and the poll is closed. So we have a large majority saying choosing one option, which is the Federal Reserve monetary policy. The second highest is oil prices, and the rest are either got none or 8%. So it is any reactions from the panel here? Brian, any thoughts? Are you surprised that such a large majority went to the Federal Reserve policy?
I think, as we'll discuss later in the program, The Federal Reserve policy shift that came from the late January announcement was one of the more stunning developments that we've seen, certainly out of central banks in recent economic history. I think it shifted a lot of the growth outlook, and it's uncertain whether or not the Federal Reserve will be able to stick with that more accommodative policy long term. So I think from a business planning perspective, it's an important unknown to consider.
Yeah. Abdul, Mark, any initial thoughts on that?
I guess to me, the most notable thing about it is that their emphasis on flexibility and policy being data dependent was a signal that their uncertainty around the forecast and the near-term course of the economy had increased pretty significantly between November and January. So, and it sounds like our attendees have picked up on that increased uncertainty, and so it makes it harder for everybody to plan.
Yeah. Abdul, any thoughts?
Yeah, so I think most of the points which we were talking about were from a U.S. perspective, but Fed interest rate policies will have also major impact globally, because also including many emerging market economies and European economies, because they are also looking at this very watchfully. So I think it is an important aspect, but I personally, I would think that some other issues like the trade negotiations and the uncertainty about the global trade is also very important, especially from a European perspective, where we already see the impact of declining global trade coming into speeding into slowing economic growth in many economies here. So indeed, Federal Reserve is an important aspect, but I think some other factors are also important for the global.
Yeah. Well, I think maybe that suggests that the concerns about global risk and events outside the United States are not viewed as important by U.S. executives, which is potentially a good thing. That this certainly was a bigger concern, especially trade issues in our previous webcast, where there was certainly more concern about that then. So I wonder, Abdul, since they are not that worried about international development, maybe we should skip the global part of this webcast. I'm joking. So Abdul, maybe you should convince our audience that they should worry a little more about what's happening in the rest of the world.
So, Gad, I think they're already worried about it also, as we have seen from our latest CEO survey, which shows significant concern in terms of declining investment sentiment by CEOs about China, India, Brazil, and other countries. So they are also worried about emerging market economies, and in general, the risk perception in the global economy is on the rise. And there is a significant concern about whether 2009 is going to see a recession in the global economy, be it because of the rising cost of production, tightening labor market and wage growth, weak currencies in emerging markets, trade disputes between the United States and China, or Brexit, or some of the political unrest in European economies, and several factors are feeding into that. But the good news is that, which comes from this chart in a way, is that at the conference board, we are not seeing the possibility of a recession in 2019. We are seeing a slowdown in the global economy. And what this chart basically tells you is that on the x-axis, we have the deviation of a country from its long-term trend in terms of leading economic indicator growth. And on the y-axis, we have the current leading economic indicator growth. So most of these countries you see which are above that zero line basically are still in the expansion territory, which includes China and Brazil, while countries which are below the line are in the slowdown territory. So you see a lot of countries, most mature economies are in the slowdown territory, and also China and Brazil and India are also approaching to that slowdown territory. Well, there is one country which is UK, which is moving to the left side, which is basically suggesting that it is going closer to the recession trajectory. So far in our leading economic indicators, the only country which we see is approaching to the recession trajectory is UK, while in all other countries, major economies, be it emerging market economies, euro area, advanced economies, we do not see that possibility, but we do see a significant decline. And some of the decline is caused by a decline in the United States, as we will see soon, and which is preliminarily driven by the fading of tax stimulus, and part of it. It also slowed down in the second half of the 2019, which we will also talk about later. While some other countries like India is going to see a decline in investment because of kind of possible wait and see approach taken by investors amid the upcoming election, and the fear that the policy's continuity will not be sustained. So a lot of things are going to be happening here, but I think in general we are going to see a slowdown in the global economy, but not a recession.
Well, thank you, Abdul. I mean, in focusing on the UK, I'm going to the next slide. So we see there that we think that there will be a slowdown in the UK. Of course, Brexit is a big risk. A hard Brexit could lead to a recession. But where maybe you can give some more details on what's the likelihood that the UK will end up in a recession? What's the most recent data coming out of there?
Yeah, so that's a very good question, because so if you look at all different aspects of UK's growth dynamics at the moment, industrial production has weakened substantially as per the latest data, and our own global consumer confidence index suggests a steep decline in consumer confidence in the UK, this December was the historically, for after a long time, after I think 2008 financial crisis, this December was the Christmas season where British retail sector growth was 0%. So Britain is already seeing, consumers and investors are already losing their confidence in UK, and the sentiment is eroding. So that is already seeing, and we are already seeing that. But now the possibilities of a recession risk is very high, of course, especially if Britain ends up with no deal. It is going to have a significant impact on the British economy. As such, we don't know what is going to happen, because the negotiation is, I mean, whether it is a deal exit or no deal exit is still not clear. And even today, Theresa May has shown some confidence that she will still be able to get through it, but we don't know what is going to happen in the coming days. So March 29, they still have a deadline, so by which we will see what is going to happen. But eventually, one thing is quite clear: the British growth is going to be substantially lower in 2019. Mm-hmm. And whether it is going to go to a recession or not, really, we'll have to wait and see. And
so in this chart, we also see more updates to our overall global outlook. So what are some of the changes that we've made in our latest update?
Yeah, so in this chart, what we see is that the yellow line is the 2018 growth rate, and the blue bars are 2019 growth rate. And what we see is that globally, we are going to see a decline in the global growth rate from 3.2% to 3% from 2018 to 2019. And this is driven by declines in both emerging markets as well as mature economies. US growth is going to slow down from 3% to 2.9%. But this chart actually, in fact, is concealing some of the underlying dynamics of growth slowdown in the US economy, because most of the slowdown is going to happen in the later part of throughout the 2019. So the average effect is limited, but I think you will see a larger impact in going through the next months. And in Europe, we are going to see a much more bigger decline from 2% to 1.6%. And some of the large economies in Europe, like UK, we have already discussed, but also economies like France is already suffering significantly because of civil protest in France, which is affecting both consumer confidence and also investors. And some of the troubled economies like Italy. So many of the large European economies are also going to see a slowdown. And this slowdown is primarily going to be driven by external sector dynamics, the weakening demand from export demand, Consumers are remaining sober, but again, that is not showing up in the retail spending data and consumption data in the euro area economy. So it is very likely that the European economies are also going to slow down. And in the emerging market economies, China is going to see a slowdown. I mean, it's going to continue its soft fall from 4.1% to 3.8 percentage growth rate. And again, China is going to see a severe setback in terms of investment as manufacturing sector and construction investment is under severe pressure, and the downward pressure is mounting. Also for the consumer sector because of rising debt burden and slowing income growth in China. India is a hotspot because it will also see a slowdown from 7.5 to 6.9 percentage. But because of the election-led fiscal stimulus in India, consumers will remain solid. But investment is likely to decline, and the trade growth is also likely to decline. So overall, the point is that the global economy is going to see a slowdown from 3.2% to 3% in 2019.
Thank you, Abdul. So that's a good time to move to the U.S. In the U.S., because of the government shutdown, a lot of the data that we usually have at this point of the month is still missing. In particular, the GDP data for the fourth quarter is still not released. The same for retail sales for December and investment data. But still, Brian, we have a lot of information that we can still make some predictions.
Absolutely. Some of the global cross currents that Abdul described were, of course, picked up by Chair Powell in announcing a more dovish Fed policy. So what does this mean in practice? What it ends up meaning is that to begin the year, our forecast expected 2 or 3 rate increases during the year. Given the latest policy announcement, it is quite possible there will be 0 rate increases during the year. Indeed, that's what markets are presently projecting. However, I think it's important to remember the condition of the economy and thinking about the sustainability of this policy. Labor markets are continuing to produce jobs at a fast pace. There's a shortage of workers. Wage growth has become more rapid than it was before. It's now above 3% according to most major measures of wage growth. And so what that means is that there is more upward pressure on prices, and there is the possibility that inflation may accelerate. And indeed, what the Fed was saying in its statement was that in the event there's a great deal of uncertainty about how growth and inflation will evolve given the slowdown in the global economy and the lack of upward movement in inflation so far. However, if the data evolve in such a way to suggest that there is more than was stated in the last month's statement, muted inflation pressure, that there's much more inflation pressure, the Federal Reserve could quite possibly boost interest rates 1 or more times during the second half of the year. So that was one major factor that caused markets to improve after losing a great deal of ground between October and December. Markets prices are now nearly back to where they were back in October. They're not quite back to record highs, but they're now much closer to those than they were back in December. The settling of the government shutdown also restored market confidence. We think that the shutdown caused about a 0.3% GDP growth loss between the fourth quarter of 2018 and the first quarter of 2019, with a lot of that coming from consumption, some of that also coming from investment, simply because government workers weren't being paid, so some discretionary short-term consumption may not have occurred. In addition, businesses may have had to delay certain investments because of a lack of access to various government approval processes. And the end result of a perception that the economy, that growth was likely to slow during the year as a result of the lessening of government stimulus measures during the course of the year, along with concerns about the government shutdown. That led to business and consumer confidence measures falling dramatically in recent months. But we would expect those to improve given the newly announced monetary policy, because I think a lot of that decline also related to fears that capital costs would increase and investments would become more expensive to make. But in the event that the Fed does stick to its new monetary policy, that is going, some of those concerns about investment are going to go away. But I think it is important to note that there is a small but non-zero possibility that the shutdown could be resumed later this week if Congress and the president are unable to come to a budget deal. So that's important to watch. I don't think there's going to be a renewed shutdown, but in that event, I think there would be greater concerns about government instability. So I think the overall takeaway is that as long as inflation can remain in check, you're likely to see a gradual slowdown of the U.S. growth rate from around 3% during the first 3 quarters of last year to around 2.2% by the end of this year, which is definitely a significant slowdown, but that's still a growth rate that's above the long-term projected 2% trend growth that the U.S. Is likely to see going forward. And then I think the other key thing to keep in mind is in the event that tight labor markets, a strong economy do produce more inflation, that's going to shape Fed policy and could perhaps dim confidence. We saw this morning that inflation numbers came out. They continued to show muted inflation growth. Markets rose. In the event that that begins to change and there begins to show more upward inflationary pressure, that could lead to more rate hikes during the year. Mark, I'd be curious to hear what the Fannie Mae perspective on the 2019 outlook is and how it may differ from ours.
So our outlook is a touch weaker than our forecast and what you penciled in for the year. We have growth for 2019 at 2.2% and then slowing further into 2020 at 1.6%. And one of the significant differences is we see a moderation in consumer spending relative to what your forecast has. And so that gives us slower growth. By and large, we're watching the same risk factors that you've brought up and that the audience has brought up with in terms of what the Fed is doing, what's happening to consumer confidence and what's happening to business confidence. One of the notable things to us has been that when you came out of the election, you had a really strong pickup in consumer sentiment, but that wasn't matched with anything like of a equal size pickup in consumer spending. So even though consumers were more optimistic about their circumstances and the economic outlook, they remained a little bit more cautious in their spending. And you've seen that in car sales, you've seen that in housing and a couple of other areas. So I guess we just have a little bit of a more cautious outlook there than you.
I think a very important factor that we see, especially in this slide, is that we are now in the middle of a significant increase in government spending as part of the Bipartisan Budget Act of 2018. So it seems, Brian, as we look into our forecast through 2020, and especially the slowdown during 2019, it seems that most of it is the evaporation of this additional growth coming from government spending.
Absolutely, and that's even more true this month because given the change in Fed policy, I think there is less of a possibility of slowdown in terms of business investment. And so a lot of that slowdown is coming right now from government spending. Now, the question is going to be, in thinking about the 2019 outlook, is how are consumers going to behave? We've seen, as you'll talk about in the next slide, a lowering in consumer expectations.
Yeah. So we had in the blue line here, this is the expectations component of our consumer confidence index. And we've seen in the last couple of months a significant decline to less than 90, which is still a positive territory if you look at 90 in during the last couple of the last 13 years. It's still it's not a bad number, but it is it does signal a significant decline in the past 2-3 months. Now, most of the January numbers were collected while there was still a shutdown. So, and we know from past shutdowns and government disruptions that this is something that consumers are very sensitive to. So I wouldn't be surprised if we see some pickup in that now that the shutdown is over, hopefully, and also stock prices are recouped most of the losses during recent months. Where I think we may see still relatively lower numbers are in business confidence. I don't know that we'll get back to the pre-stock prices collapse we had in October, November, December. But it's still not in, at least in this measure here, the ISM manufacturing index, it's not terrible numbers either. Another important measure that we should keep an eye on, and the Fed is certainly keeping an eye on, is what's happening to inflation. The Fed essentially decided or paused on the rate hikes because they believe that inflation is not going to pick up much. We are seeing here in the blue and the red line are the two measures of core inflation. They are around the Fed target of 2%. The blue line is the number that they take more seriously, and that's still a little below the target, but we're very close to the target. And if indeed we will see more companies passing higher costs, higher labor costs to the consumption, we may see some additional pickup in inflation. And this is something that the Fed would view very closely. And if it is rising faster than they currently expect, they will probably raise interest rate. So it's not at all clear that that the markets are right in predicting zero rate hikes. We see a very clear acceleration in wage growth and labor cost. So it could very well end up in consumer prices later in the year. Brian, you prepared this slide on the kind of different scenarios of Federal Reserve policy. You want to talk about that a little?
So I think it's important to keep in mind two dimensions for different scenarios in terms of how Federal Reserve policy and the outlook could play out. Will confidence, business and consumer, rebound to levels seen before the Federal Reserve policy announcement? And will inflation begin accelerating or not? And those two questions are not completely separate, simply because as consumer demand rises, as pressure on labor markets rise, that of course increases the chances that inflation may pick up, forcing the Federal Reserve to raise interest rates during the second half of the year. So briefly, this scenario in the top left corner is the Goldilocks scenario continuing. Confidence comes back, inflation does not pick up, the Federal Reserve is able to maintain this new monetary policy and this monetary policy shift, and the end result is that we probably see less of a slowdown during the year than is currently envisioned in our outlook. There's also the possibility, as shown in the top right, that confidence comes back, but inflation starts picking up. And so you have a period of faster growth during the first half of the year, but then fears about changes in Federal Reserve policy begin to crop up that starts causing interest rates to rise and starts deterring investment. And you may see 1 or 2 rate increases during the year. There's also the possibility that maybe investment appetites simply aren't as strong as otherwise would have been believed. And so lower interest rates do not cause a reacceleration in terms of investment. This helps inflation stay under control, as shown in this bottom left scenario. But the end result is that there's not much of a pickup in growth and a clear slowdown during the course of the year. And then finally, the worst case scenario is what's in the bottom right, which is that confidence is not restored by the Fed action. There are still concerns that inflation will rise, and as a result, to expect rate hikes later in the year. This could also play out as a result of external shocks, such as a rise in oil prices. And so the end result of this scenario is that investment stays relatively cool during the first half of the year, cools further in the second half, and we get a larger slowdown than is anticipated. Right now, markets are clearly pricing in that first Goldilocks scenario, that inflation will stay under control, that maybe the slowdown will be less severe than was initially anticipated during the year. And you can see that stock prices in the red line have recovered most of their losses from December. But I think it's important to keep in mind these other scenarios, and that the shift in Fed monetary policy is not by any means a certainty.
Mm-hmm. So what is our, in our forecast that we see here, what scenario is reflected and what's our overall outlook?
So right now, the scenario that's reflected is somewhere between the Goldilocks scenario playing out and a scenario where the Fed policy move has less of an impact, but that you don't necessarily see you wouldn't see more than one rate increase during the second part of the year. So we expect a clear slowdown from the first half to the second half of the year. But I think one area that's particularly interesting is residential investment, where the housing market has clearly underperformed the economy for the past 2 years. We anticipate that to continue. You could see that residential investment growth is going to be around 0% during the course of 2019, with a chance for a recovery in 2020. But certainly, Mark can provide more details on exactly what we can expect from the housing market to come and how that relates to some of the issues that we've discussed shaping the overall economic outlook.
Yeah, so that's, Mark, we are moving to your section of the presentation. What you may want to start with some kind of overview of your main thoughts about the housing market.
Sure. I think it's a great time to talk about the housing market at this point. I guess overall, our general view is that the fundamentals are reasonably positive for the moment. Last year was a disappointing year for housing as consumers appeared to be pulling back with the rise in mortgage rates that we saw, and builders had an increase in their inventory that was a little bit unexpected and has led them to pause a little bit while they wait to see what happens with consumer confidence around housing. If we have relatively benign interest rate forecast at the long end of the curve. So far in this discussion, we've been talking about Federal Reserve policy that really drives the short end of the curve and what's happening to the Fed funds rate. For housing, the key question is what's going to happen for mortgage rates. Had we had this webcast in October, we would have been talking about the fact that mortgage rates were up over 100 basis points over the previous 12 months and that had really dampened housing demand. At this point, mortgage rates are back down to the 4.5 level in the 30 years, so that's a real positive. And our forecast is for mortgage rates to be relatively flat for the rest of the year. So that should help regain some momentum on the demand side. Now, there are risks in that we do a survey of consumers every month, and we've really seen that survey, and I'll go through that later, that the strong home price appreciation over the last years has really become an issue of concern, and it's a practical one around affordability and the ability of both first-time home buyers and move-up buyers to be able to move into the market.
Thanks, Mark. So it seems like a lot of this starts and ends with demographics. So how are demographics playing into the housing market right now?
So the background for demographics in terms of overall demand is actually pretty positive for the U.S. housing market. On this slide, what I've provided on the left side is the distribution of the U.S. population by age. And then the vertical line you can see in black there shows the current median age of first-time home buyers. So if you look behind that among the younger cohort than that median, including most of the millennials, you do actually have a nice wave of people coming into the system as potential buyers. The other key point is that despite the downturn and then the crisis, American households and American individuals remain really positive on housing. They want to own. And when we survey renters, you can see on the right side, over 80% of them say they want to own at some point in the future, and 90% of young renters, defined here as 25 to 34, are likely to own at some point in the future. So, the demographics and the attitudes are there to help sustain demand for housing.
Why do you think is, and you get into some of the higher interest rates, higher unemployment rates on the next slide, but why do you think is that despite having experienced a very unstable economy during most of their working lives, millennials are still so committed to the idea of purchasing homes, even in a market that, as you'll get into later, features such high housing prices?
Right. I think that the key driver that if you wanted to model home ownership, the key things that lead people to go from renting to owning is getting married, having children, and getting older up until your late 70s, when then you start to see rentership pick back up. And those factors are all still a factor, and I think people's views of what they want out of life, maybe Maslow's hierarchy of needs really haven't changed. It's just that this group was hit particularly hard in the downturn, and you can see that on this unemployment slide, right? That the current downturn was particularly hard for young people and for employees overall and for households overall. And it's taken a long time for their economic circumstances to improve to the point where they could go from an aspiration to own to actually acting on that aspiration. And at least the one piece of positive news is you have seen the home ownership rate come off the bottom, and it's now at 64%, and you've seen a real pickup in home ownership among younger cohorts.
And how exactly has that played into the fact that you had this period of higher unemployment rates? How has that played into life cycle decisions such as the timing of deciding to form households?
Yeah, so you've seen household formation pick up. It got hit particularly hard with the downturn. The data is messy. You can see it here. The average over the recent decades has been about 1.2 million households a year. Now we've exceeded that in the last year, so that's a a real positive. So really, it was a delay in the formation of households because of the tough economic circumstances. But now we're playing catch up, and that catch up has really translated into the strong demand and contributed to a low inventory of housing. On this chart, what we've looked at is age cohort transition rates through time. So, for example, on the left, in the first set of bars, you're looking at a group of households who are 20 to 21 and how much the home ownership rate goes up as they go to 22 and 23-year-olds. And then we've looked at that pre-crisis and all the way to the most recent data in 2017. And if you look, for example, at that, again, that first group, pre-crisis, during that time period, they increased the home ownership rate by 2%. That went down to a little bit above 1% post-crisis, now has started to pick up in that blue line. If you step away from this chart, what you can see is that the peak of the blue line, the dark blue line, the most current data, has moved from the 24 to 25-year-old cohort over to that 26 to 27. So you see the delaying. Student loans have contributed. The slower recovery contributed to that. But the other thing that's noticeable is you really start to see a pretty good pickup in the incremental gains in those 2-year periods in home ownership. So that's one of the things that's been a real positive in the housing market.
Mm-hmm.
Now, as I mentioned in the beginning, last year was actually a little bit of a disappointing year for housing, and so despite the strong pickup, you can see here on this chart, we've just given existing home sales and new home sales. Those were basically flat and down last year, bobbing around. So it was a disappointing year. And interest rates were clearly one of the culprits that impacted it. Now, one of the questions around interest rates is that a rise in mortgage rates does not always lead to a slowdown in sales, but in the past, it has in certain times. You can see that here with the taper tantrum on this chart in 2013, the 30-year mortgage rate at the bottom, and then existing home sales along the top. Rates spiked, as you maybe recall, when Bernanke had a little bit of a miscommunication with the bond market. Excuse me, and you saw a drop-off in sales. In 2017, when rates went up again after the election with a bond market forecasting stronger nominal GDP growth, housing actually did pretty well, and you didn't have a drop-off. Consumer sentiment was so strong, the pickup we saw there. I saw it in your graphs, too, earlier, that the housing weathered it. Last year was a little different, right? We had a substantial increase again in mortgage rates, and it caused a pause in the housing market.
Mark, there's a question here, going back to the demographic topic. There's a question from the audience. Will home ownership uptick by millennials be canceled out by the boomers aging out? Any perspective on this long trend?
Yeah, it's a really good question. If you go out maybe a decade from now, that really becomes even more in focus. So there's been discussion among, in the press, among housing economists as to what are the intentions of the boomers, and are they all giving up on ownership and moving downtown and buying a condo? When you look at the actual data, the baby boomers are actually staying put in their single-family homes in the suburbs at the same rate as prior generations. The difference is there's such a large group that when they do anything, it's very noticeable. And as they're moving into the retirement years, if you are running an apartment in a central urban area, you're seeing more baby boomers. But as a group, they have not at this point given up on their single-family homes, and actually a number of them are upsizing in order to welcome the grandkids back. Obviously, as the saying goes, tides in time wait for no man, and at some point, medical challenges, the loss of a spouse, just the aging process makes it harder and harder to stay in that single-family suburban home. So at some point, there likely will be an increased exit, and the millennials and the generation after that will have to take up the demand for those homes.
So is that going to shift demand among older home buyers into more urban locations, or is that going to shift demand towards retirement-centric locations like South Florida?
So it's a couple of parts playing into that. One of them is the tax changes that you've seen that have affected the higher tax blue counties and blue states, like where I live in Montgomery County, Maryland. That's probably going to dampen a little bit demand to live in those places in retirement and accelerate the move to lower tax states. So that's one phenomenon that I think your question picks up on, that is likely going on in the background and is a change over previous years. But by and large, I don't think that baby boomers are behaving that differently from the prior generation. At least that's what the data suggests.
No, that makes. Oh, sorry.
So
no, go ahead.
Go ahead, please. I was just going to mention that one of the reasons I think the spike in interest rates had somewhat of an effect is what you can see in this chart here, which takes the ratio of existing and new home sales to median family income. And you can see if you went back, for example, with existing home sales going back to 75 all the way through the late 90s, that the ratio there was somewhere around 2.5%. That was kind of a rule of thumb, right? That people had don't spend more than 2.5%, at most 3% of your income as a multiple on your house. And you can see that new home sales were a higher price point relative to incomes, but also relatively flat. And then you've got the runoff from the housing, the run up from the housing bubble and decline. And then on the right side, you can see that new home sales, new home prices relative to incomes have continued to rise. And the construction industry has not been able to respond to the home price changes the way one might expect. And also that has then led to particular more pressure on the existing home market as people are not moving up into the new home market as much as they used to.
And I think your distinction between the existing and new home markets really plays in well to your next slide, where you start discussing which are those metros where you're seeing the highest, the most inflated house prices.
Yeah, in this analysis, what we tried to do is take a look at what was the current impact, so last year, of affordability concerns, and could we see a difference across metros based on how costly they are. So we divided up metros by ratio of median home price to median income, and then looked at what happened to total sales and the number of listings on the market. So on the left side, you can see this is for metros where the median house price is 6 times or more the median income. Obviously, these areas have a lower home ownership rate. San Francisco would be, a clear example of a metro in this group. And you can see in the brown boxes that annual sales year-over-year sales actually declined in those metros, and the number of listings on the market went up. And as you move to the right, to the more affordable markets, you can see a lot less of a slowdown, both in sales, and then you actually see the inventory was even declining in the more affordable markets. So that's kind of that change dynamic. The other place you've seen it is, if you think about jumbo pricing point versus, conforming mortgage that can be sold to Fannie or Freddie, you've seen more of a slowdown and a buildup in inventories in jumbo price neighborhoods than you have in the more middle income neighborhoods that are covered by Fannie, Freddie, and FHA loans. So the other place, as I mentioned in the introduction, where we see some caution is in our home sentiment purchase index, which has declined for a good part of last year, and you can see that on the left. We had a little bit of tick up in January, but still the trend is one of decline. And if we then go into that to look at the components, the key component that has had a substantial trend in one way is of those who are saying it's not a good time to buy, the key reason is house prices, and house prices are too high. That's the line that I've made bolder in black, and that one has just steadily risen with the increase in home prices. So consumers are really feeling the affordability and getting a sense of it. The other thing that's been going on is we also see consumers, having taken on a little bit more debt and now appear to have reached a point where they're not comfortable taking on too much debt. So in this chart, what we've done is we've used census data to look at recent movers who are 25 to 34-year-olds and homeowners, and what percentage of their pre-tax income is being used on all home costs, so the mortgage plus utilities. And you can see from a baseline in the census of 2000 that less than 30%, those spending less than 30% of their pre-tax income was a little under 70%. And then, for example, in contrast, those spending over 50% was that red bar at the top. By 06, with the, strong appreciation in home prices and the affordability issues, that red box has become quite large. With the tightening of underwriting standards, you see that has diminished substantially over time. But I think that the thing that's interesting to me in terms of consumer attitudes is the green boxes. As you go through time on the right, where coming out of the recession, people were a little, you had some caution, substantial caution, people being careful about not taking on too much debt, and then, that's sort of flattened out. Despite the strong economy, that's kind of paused, and you don't really see a big increase in the red box. And that's consistent with what we've seen consumers do on the spending side, where we've seen an uptick last year in the savings rate. So what's going on with inventories? I've mentioned that a few times. If you look at the inventories available for sale as a percent of the overall number of households, beginning first with existing homes for sale in the blue line here, you can see that number remains really low by historical standards. If you've been out looking for a house, you've probably encountered this. All of last year, there was really very little on the market, and that's one of the things that contributed to discouraging consumers. If you look next at the new home market, new homes available for sale relative to the population, those dropped to historic lows after the downturn, and they've gradually increased, and now they're probably back to the low end of what you would expect in terms of inventory in the marketplace. So, but really the tight inventory in the existing home market is one of the things that has just led to a slowdown in transactions. The other key factor that's what is so different this time around, and people ask me, has the housing market returned to normal after the crisis? Most parts of it have. The one place that has not, the one relationship that is still has broken down is the response of new home supply, so construction of new single-family homes relative to what's going on to prices. So in this chart, what we've shown you is single-family starts in the orange line, and then year-over-year change in home prices. And you can see those are pretty well correlated. As demand increased and home prices went up, builders responded and built more houses. You can see the dramatic decline, obviously, with the housing crisis. And then we've had home prices pick up pretty significantly in the years since then, but home construction has not responded. So that's the one thing that really is coloring the whole of the housing market. Because if you don't have the sufficient new homes being built relative to the demographic potential and relative to the strength of the employment market, then you have people bunching up in the houses that they do have, and you don't get the freeing up of first-time home buyer entry-level homes by move-up buyers. The system sort of gets backed up, and that's what's really led to the affordability issues that you see in the marketplace.
So Mark, why is that? What are the main reasons that single-family starts didn't recover much?
So there are a number of reasons that have played into that. One is, and they've sort of shifted over time, right? Coming out of the crisis, you had really tight credit for builders. You had a large excess inventory of foreclosed homes that were coming onto the market, of short sales, so where the bank agrees to let you sell the home and have sort of a graceful exit. And so that was an overhang on the market. After that, at least the builder surveys, and when we talk to them, there are a number of issues that have held back supply. One of them is labor. People had to continue to feed their families, and after an 80% decline in single-family starts and substantial layoffs in construction workers, the workers went away and found other employment. And so builders have had a hard time getting the skilled labor they need. You've seen some increased skepticism around the country by local and state government around large-scale development. So that has made it harder and driven up the price of land. And then material costs have also gone up. So you take all of those things together, and you've had more infill development, tear downs and rebuilds. You've had far fewer entry-level construction of, traditional townhome development or suburban condos, which is entry level. If you look at the data on square footage, for example, it gives you a window into that phenomenon. Most of the construction has been above 2,500 square feet. You've only now finally in the last year or two started to see some pickup in smaller sized homes.
I mean, one really interesting thing about this chart is that it does play into your dichotomy between the existing and new home markets as being separate markets with separate dynamics, where there is much more demand for the existing homes, simply because they are in those most desirable areas in a lot of cases where it is more difficult to build. But do you think that in 2019, maybe you'll have a market correction, maybe price growth will slow, and that's going to allow home construction activity and home demand to sort of level out much more into 2020, and for the market to come back into equilibrium a little bit?
And maybe, Mark, when you answer this question, maybe you can do it with, we are kind of running out of time, so I'm skipping to the forecast slide that you have here. So maybe you can answer Brian's question using this slide.
Yeah, and I think that's very helpful. If you look at the middle of the slide where we have what's labeled FHFA Purchase Only Index, that's our home price forecast. And you can see home prices were rising at 6.9% in 2017. We think they've slowed down to 5.5% in 18, and we're forecasting the rate of appreciation will continue to slow with a 4.2 and 2.8. I wouldn't put too much stock in the exact number after the decimal point. But the point is that we do think there's some slowdown in the rate of appreciation, which will help with affordability. The other notable thing in our forecast is the second to last line, which is the 30-year mortgage rate. And we have that. These are the annual average rates. And within the year, there's obviously a lot of fluctuation and volatility like we saw last year. But, we have yields basically in mortgage rates basically being flat over the next 2 years, which should help with affordability. So when you take those things together, last year we had a decline in total existing home sales. You can see that in the third line. We're projecting this year, the third and fourth quarter was sufficiently weak that we're just showing a flat year basically in 2019. And as you're coming off that really weak end of the year, and you've got to have decent growth every quarter just to get to flat, and then a modest pickup in the following year. So the question obviously is, this is a relatively benign soft landing for housing, and there were all those risks that we went over on the macro side, which then weigh a little bit against this.
Well, thank you very much, Mark. That was very interesting, and I think we all know much more about the current housing situation and the outlook. I just, before we conclude, I just want to remind our viewers that, as usual, next month we'll have the Economics Watch webcast and the suite of publications related to that. next month, the next Economics Watch, we're going to talk about the Fed, inflation, and interest rates. That would be the main topic of that webcast. If you want to, what Abdul presented earlier is an update of our global economic outlook. You can go to this website and get the most recent data and information from there. And you can use this code to get a discount on this upcoming conference, 17th Annual Change and Transformation Conference, if you're interested. And if you have a minute to give us some feedback, we will greatly appreciate that. I want to thank Mark, Brian, and Abdul. Thank you very much for being with us today. And to all of viewers, have a good rest of the day.